One of the hardest truths for any investor to accept is that successful investing often feels wrong while you are doing it. If it feels obvious, comfortable, or widely accepted, it is almost certainly already reflected in prices. Markets are brutally efficient at absorbing consensus opinions. What everyone knows is what no one profits from. This is why intelligent investing is counterintuitive. It requires actions that go against instinct, emotion, and social reinforcement. You must buy when others are fearful. You must sell when others are euphoric. You must accept uncertainty when others crave certainty. And most importantly, you must be willing to look wrong sometimes for long periods of time. The psychological cost of being different. Markets are not just financial systems. They are social systems. Human beings are wired to seek validation from the group. Acting independently creates discomfort, doubt, and fear of embarrassment. When you buy something that everyone else hates, you feel isolated. When you refuse to buy something everyone loves, you feel foolish. This psychological pressure is one of the greatest obstacles to disciplined investing. As Howard Marks has often emphasized, the hardest part of investing is not analyzing numbers, it is maintaining emotional discipline in the face of uncertainty. Most people abandon sound principles at precisely the moment those principles matter most. Why the crowd is usually wrong at the extremes. Markets tend to be most wrong at turning points. At peaks, optimism is extreme. At bottoms, pessimism is absolute. This is not coincidence. At market highs, good news is exaggerated. Risks are dismissed. Valuations are ignored. Stories replace analysis. At market lows, bad news is extrapolated endlessly. Fear overwhelms logic. Prices collapse below intrinsic value. Liquidity disappears. The crowd is not foolish in the middle of the cycle. It is foolish at the extremes. And it is precisely at the extremes that the greatest opportunities and risks exist. The illusion of certainty. One of the most dangerous things an investor can feel is certainty. Certainty breeds overconfidence, excessive leverage, concentration, ignoring downside risk. Markets punish certainty because certainty ignores randomness. As discussed earlier, outcomes in investing are probabilistic, not deterministic. Even the best analysis does not guarantee success. The belief that this time is different has destroyed more fortunes than ignorance ever could. Why forecasting feels useful but isn't. Investors love forecasts because forecasts reduce anxiety. A forecast provides a narrative. Interest rates will rise, the economy will slow, this sector will outperform. Narratives feel comforting. They create the illusion of control. But forecasts rarely add value. As economist John Kenneth Galbraith famously observed, forecasters fall into two categories. Those who don't know, they don't know. Forecasts that simply extrapolate the recent past are often correct but useless. They are already reflected in prices. Forecasts that predict radical change can be valuable, but only if they are right. And almost no one is consistently right at predicting radical change. This is why Marks and his firm avoid making investment decisions based on macroeconomic forecasts. They acknowledge uncertainty instead of pretending to eliminate it. It's okay to have an opinion, just don't bet the farm on it. One of the most practical investing principles is this. It is fine to have opinions. It is dangerous to act as if those opinions are facts. Markets regularly humble people who confuse conviction with certainty. Holding strong beliefs without margin for error leads to fragile portfolios. Fragile portfolios break under stress. Robust portfolios are built on humility, diversification, and risk awareness, not confidence. Why being early is the same as being wrong. One of the cruelest realities in investing is that correct ideas can fail simply because of timing. If you buy something undervalued but the price does not converge with value for years, you may be forced out by performance pressure, client redemptions, psychological fatigue, opportunity cost. From the outside, early looks exactly like wrong. This is why patience is not optional, it is essential. And it is why leverage is so dangerous. Leverage shortens your survival window. It forces timing to matter. Survival is the first rule of investing. Investing is not about maximizing returns in any given year. It is about surviving across decades. A strategy that occasionally produces spectacular returns but periodically wipes out capital is not a successful strategy. Losses hurt more than gains help. A 50% loss requires a 100% gain just to break even. This asymmetry is why avoiding large losses is more important than capturing large gains. This principle underpins everything that follows. Why risk control comes before return? Most investors talk about return first and risk second. Professionals reverse the order. They ask, what can go wrong? How bad can it get? Can I survive it? Will I still be standing afterward? Only after answering these questions do they consider return. Risk is not volatility. Risk is not price movement. Risk is the permanent loss of capital. And permanent loss often comes from ignoring the downside while chasing the upside. The loser's game revisited. Charlie Ellis's concept of investing as a loser's game is often misunderstood. It does not mean that winners do not exist. It means that most participants are better served by avoiding mistakes than by seeking brilliance. In amateur tennis, the player who commits fewer unforced errors usually wins even without hitting winners. In investing, the investor who avoids overpaying, excess leverage, blind optimism, trend chasing, narrative-driven decisions often outperforms over time. Not because they are brilliant, but because they are disciplined. Why avoiding losers is so powerful. The power of avoiding losers comes from mathematics, not philosophy. If you avoid catastrophic losses, compounding works. Volatility becomes survivable. Time works in your favor. As Marx has often summarized the idea, if we avoid the losers, the winners will take care of themselves. This is not a call for passivity. It is a call for selectivity. The importance of second-level thinking. Most investors operate at the first level of thinking. First-level thinking sounds like this. This is a good company. This industry is growing. Earnings are increasing. Second-level thinking asks, is it better than the market expects? Is the price already reflecting that growth? What happens if expectations are wrong? Superior investors do not just ask whether something is good. They ask whether it is better than expected, because markets move not on facts, but on surprises. Expectations matter more than reality. This is one of the most important insights in investing. Prices are driven by expectations versus outcomes, anticipation versus reality. A mediocre result can be great if expectations were terrible. A strong result can be disastrous if expectations were unrealistic. This is why buying unloved, ignored, or distressed assets can be so profitable if they survive. And survival is the key word. Buying what others reject. Contrarianism, distress, and asymmetry. Why the best opportunities never look like opportunities. The greatest investment opportunities rarely announce themselves clearly. They do not arrive with confidence. They do not arrive with applause. They do not arrive when conditions feel comfortable. They arrive when assets are rejected, avoided, misunderstood, or feared. This is not accidental. Markets price assets based on collective psychology, not intrinsic truth. When fear dominates, prices fall below value. When optimism dominates, prices rise above it. If you want to buy assets for less than they are worth, you must be willing to buy them when others refuse to. That is the essence of contrarian investing. Contrarianism is not about being different for its own sake. Many people misunderstand contrarianism. They think it means always doing the opposite of the crowd, being provocative, rejecting consensus automatically. That is not contrarianism, that is rebellion. True contrarianism is conditional. You act differently only when the crowd is demonstrably wrong and when prices reflect that error. If the crowd is optimistic and correct, fighting it is foolish. If the crowd is pessimistic and correct, fighting it is foolish. The goal is not to be different. The goal is to be right when others are wrong, and that only happens at extremes. Why popularity is a risk factor. Popularity feels safe. When many people agree with you, doubt fades. When prices rise, confidence increases. When everyone owns the same asset, fear disappears. But popularity is not safety. Popularity means expectations are high. High expectations mean disappointment is more likely than surprise. In investing, risk often comes from what is widely loved, not what is widely feared. The most dangerous words an investor can hear are, "Everyone knows. You can't lose. This time is different." It's a sure thing. When something becomes universally accepted, its price already reflects perfection. Why? Discomfort is a feature, not a bug. If an investment feels easy, it is probably overpriced. If it feels uncomfortable, it may be undervalued. This does not mean discomfort guarantees opportunity. Many uncomfortable investments are simply bad. But no great investment opportunity feels comfortable at the moment of purchase. Fear is the mechanism that creates bargains, and fear does not coexist with comfort. The role of expectations in creating opportunity. Every investment outcome depends on expectations. Markets do not react to events. They react to events versus expectations. If expectations are terrible, merely surviving can produce strong returns. If expectations are euphoric, even excellence can disappoint. This asymmetry is what creates opportunity in distressed, unpopular, or misunderstood assets. Distress, where price and psychology disconnect. Distressed investing exists at the intersection of fear, complexity, forced selling, uncertainty. When companies enter distress, many investors are forced out, not because the assets are worthless, but because rules, mandates, or emotions require them to sell. This forced selling drives prices far below intrinsic value. Distress does not mean worthlessness. It means uncertainty. And uncertainty scares people more than bad news. Why forced sellers create mispricing. One of the most important sources of opportunity in markets is forced selling. Forced sellers do not care about price. They care about liquidity, rules, or survival. Examples include institutions prohibited from holding below investment-grade debt, mutual funds facing redemption, banks reducing risk exposure, investors panicking during crises. When sellers must sell regardless of price, buyers with patience gain leverage. This is how prices fall below value, the birth of high yield and distressed investing. For much of financial history, anything below investment grade was considered uninvestable. It was labeled speculative, undesirable, unsafe. Ratings agencies even described certain bonds as not possessing the characteristics of a desirable investment. No mention of price, no mention of valuation, just a blanket judgment. This intellectual error created opportunity. Because something is risky does not mean it is overpriced. And because something is safe does not mean it is cheap. Why bad companies can be good investments. This is one of the most counterintuitive truths in investing. A bad company can be a great investment. A great company can be a terrible investment. Why? Because investment outcomes depend on expectations versus reality. If a company is expected to fail and merely survives, investors can make money. If a company is expected to dominate forever and merely performs well, investors can lose money. This is why buying assets with low expectations is often more profitable than buying assets with high expectation. Survival is the key variable. In distressed and high-yield investing, survival matters more than excellence. You do not need perfection. You do not need growth. You do not need brilliance. You need survival. If a distressed company survives, debt gets repaid, bonds accrete to par. Equity claims regain value. Optionality emerges. If it does not survive, capital is impaired. This is why intelligent distressed investing focuses less on upside stories and more on downside avoidance. The negative art of bond investing. Bond investing reveals a powerful principle. If a bond promises a fixed return, every bond that pays delivers the same return. The only difference is whether it pays or defaults. This makes bond investing a negative art. Performance does not come from selecting the best bonds. It comes from avoiding the ones that fail. If you avoid default, returns take care of themselves. This insight scales beyond bonds. It applies to all investing. Asymmetry, limited downside, meaningful upside. The most attractive investments share a common feature: asymmetry. Asymmetry means downside is limited, upside is meaningful. Probabilities favor survival. Distressed assets often offer this profile because prices already reflect disaster. Expectations are minimal. Improvement, not perfection, drives returns. When pessimism is extreme, you do not need everything to go right. You only need things to go less wrong than expected. Why most investors cannot exploit distress? If distressed investing is so attractive, why doesn't everyone do it? Because it requires emotional resilience, analytical depth, legal and structural understanding, patience, comfort with ambiguity. Most investors hate uncertainty, avoid complexity, fear reputational risk, cannot tolerate drawdowns. Distressed investing looks ugly while it is working. That is why it works. Why simplicity is overrated in investing. Many investors seek simple stories, clear growth narratives, easy explanations, linear projections. But markets price simplicity aggressively. Complexity repels capital and mispricing often lives there. Distress, restructuring, and uncertainty create complexity. Complexity creates avoidance. Avoidance creates opportunity. When contrarianism fails, contrarianism is not a guarantee. Buying what others hate can still be wrong. Assets can be cheap because they deserve to be cheap. Distress can lead to default. Low prices can reflect real impairment. This is why contrarianism must be paired with analysis and risk control. Being early, wrong, or stubborn can be fatal. The role of judgment. There are no formulas here. No algorithm can tell you when fear is excessive or when pessimism has gone too far. This is where judgment matters. Judgment is developed through experience, mistakes, pattern recognition, humility. This is why great investors are rare and why imitation rarely works. Why time is an investor's greatest ally and enemy. Time rewards patience but punishes fragility. If you can survive long enough, mispricing often corrects. But time exposes leverage, overconfidence, poor risk control. You cannot wait for value to be realized if you are forced out early. This is why liquidity, balance sheet strength, and margin of safety matter so much. Buying what others reject, contrarianism, distress, and asymmetry. Why markets systematically misprice risk? Markets are not machines. They are emotional systems populated by human beings operating under pressure, incentives, and fear. Because of this, markets do not misprice assets randomly. They misprice risk in predictable ways. They underestimate risk during good times. They overestimate risk during bad times. This is the recurring flaw that creates opportunity. When conditions are stable and returns are strong, investors gradually become complacent. They loosen standards. They accept lower returns for higher risk. They convince themselves that volatility has been eliminated. Then something breaks, and when it does, fear rushes in faster than logic ever could. Prices fall not to fair value, but well below it. The pendulum of psychology. Investor psychology swings like a pendulum. At one extreme, fear dominates. Risk is exaggerated. Liquidity disappears. Assets are abandoned. At the other extreme, greed dominates. Risk is dismissed. Leverage increases. Assets are worshipped. The pendulum never rests in the middle for long. It overshoots in both directions. Successful investors do not try to stop the pendulum. They position themselves to benefit from its extremes. Why fear is more powerful than greed? Fear is a stronger emotion than greed. Greed whispers promises. Fear screams warnings. When fear takes hold, rational thinking collapses. People sell not because value has disappeared, but because anxiety becomes unbearable. This is why crashes are violent and fast, while recoveries are slow and hesitant. And this is why distressed assets can fall far below intrinsic value. The role of institutional constraints. One of the least understood drivers of market mispricing is institutional constraint. Large investors operate under rules: minimum credit ratings, liquidity requirements, regulatory limits, mandated risk profiles. When assets fall below these thresholds, institutions are forced to sell regardless of price. This selling has nothing to do with value. It has everything to do with compliance. When enough institutions are forced sellers at the same time, prices collapse. This is not a failure of analysis. It is a failure of flexibility. And it creates opportunity for those without the same constraints. Why liquidity is often mispriced. Liquidity is most valuable when it disappears. In calm markets, liquidity is taken for granted. Investors assume they can sell whenever they want. In stressed markets, liquidity vanishes. Bid-ask spreads widen, buyers disappear, prices gap down. Assets that require liquidity suffer disproportionately during crises, not because they are worthless, but because buyers are scarce. This is another reason prices fall below value. Investors with patience and capital gain leverage precisely when others lose it. Distress is not a permanent condition. One of the biggest mistakes investors make is assuming that distress equals permanence. A company in distress today may not be distressed tomorrow. Markets often treat distress as terminal when it is merely transitional. This creates opportunity. Distress can come from excess leverage, temporary demand shocks, cyclical downturns, poor timing, macroeconomic stress. Not all distress reflects a broken business. Separating temporary problems from permanent impairment is the essence of intelligent distressed investing. Why survival is undervalued. In euphoric markets, investors focus on growth. In distressed markets, survival is enough. If a company survives, debt matures, cash flows normalize, assets regain relevance, optionality reappears. Markets often price assets as if survival is unlikely, even when probabilities suggest otherwise. This mismatch between perception and probability creates asymmetry. Asymmetry explained more precisely. If you've made it this far, you already understand something most investors never do: that real investing is not about excitement, predictions, or shortcuts. It's about discipline, patience, and the willingness to think differently when it matters most. Everything you've heard here is grounded in decades of real-world experience through booms, crashes, fear, euphoria, and everything in between. These principles don't promise easy money. They promise something far more valuable: survivability and long-term success. If this perspective helped you think more clearly about money, risk, and investing, take a moment to support the channel. Please like the video. It helps this content reach people who need it. Subscribe to the channel if you want more long-form, no-hype insights on investing, wealth, and financial reality content designed to help you avoid costly mistakes and think independently. Thank you for watching. And remember, in investing, it's not about being brilliant. It's about not being foolish.